Preparing for a FP&A Analyst at Kraft Heinz interview, you've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A do, and how would you add value as an analyst at Kraft Heinz? FP&A connects financial performance with business decisions. At Kraft Heinz, I would support budgeting, rolling forecasts, monthly reporting, and variance analysis across brands, markets, and functions. I would not simply report that sales missed plan. I would isolate price, volume, mix, promotion, and foreign exchange drivers, then discuss corrective actions with commercial and supply chain partners. My value would come from producing accurate analysis quickly, challenging assumptions constructively, and communicating conclusions clearly enough to influence decisions. While answering, focus on planning, forecasting, performance analysis, decision support, cross-functional partnership, and translating financial results into practical actions for brands, operations, sales, and senior leadership. Question 2. How would you build an annual budget for a Kraft Heinz business unit? I would begin with the strategic targets and prior year actuals, then build a driver-based budget rather than applying a simple percentage increase. For a Kraft Heinz brand, key assumptions could include volume by channel, pricing, promotional investment, product mix, commodity costs, manufacturing efficiency, distribution expenses, and headcount. I would validate assumptions with sales, marketing, procurement, and operations, consolidate submissions, investigate gaps to leadership targets, and document the final assumptions so the budget remains auditable and useful. Make sure to cover historical performance, strategic objectives, bottom-up operating assumptions, volume, pricing, promotions, commodities, labor, overhead, capital spending, consolidation, review cycles, and alignment with leadership expectations. Question 3. How do you approach a monthly forecast, and how is it different from a budget? A budget is the approved plan, while a forecast is management's current estimate of what will happen. I would update the forecast using actual results through the reporting period and refreshed assumptions for remaining volume, pricing, promotions, costs, and foreign exchange. I would compare the latest outlook with budget and prior forecast, quantify risks and opportunities, and explain changes clearly. At Kraft Heinz, a timely forecast could help teams respond to demand shifts or commodity volatility before year-end. In your answer, talk about budget as an approved baseline, forecast as the latest outlook, updated operational drivers, actual-to-date results, remaining period assumptions, risks, opportunities, and forecast accuracy monitoring. Question 4. Walk me through how you would analyze a sales variance. I would first reconcile reported sales to the general ledger and confirm the comparison period. Then I would decompose the variance into volume, price, mix, promotion, foreign exchange, and timing effects. I would drill into brands, customers, channels, and markets to identify the underlying cause. For example, higher revenue could reflect pricing but mask declining units. I would summarize the drivers, distinguish controllable from external factors, and recommend actions such as repricing, promotion changes, or revised demand assumptions. Be sure to mention price-volume mix decomposition, customer and product level detail, promotional effects, foreign exchange, timing, data validation, root causes, and recommended commercial actions. Question 5. What is price-volume mix analysis, and why is it important in consumer packaged goods? Price-volume mix analysis explains whether revenue changed because customers bought different quantities, paid different prices, or purchased a different assortment. In consumer packaged goods, that distinction matters because a sales increase may come from price inflation while units decline, or from premium mix that improves margins. I would calculate the components consistently, investigate promotional and customer effects, and connect the result to gross profit. That gives Kraft Heinz a clearer basis for pricing, assortment, and investment decisions. Focus on separating revenue changes into units, realized pricing, and product or channel mix, while explaining promotional complexity, margin implications, customer behavior, and how management uses the analysis. Question 6. How would you analyze gross margin declining despite stable revenue? I would bridge gross margin from the prior period, starting with revenue and then isolating price, volume, mix, promotion, commodity, packaging, labor, freight, manufacturing efficiency, and foreign exchange impacts. Stable revenue can still produce lower margin if input costs rose, mix shifted toward lower margin products, or promotions increased. I would confirm actual costs and classifications with accounting and operations, quantify recoveries from pricing or productivity, and present a concise bridge showing both causes and management actions. In your answer, cover pricing versus cost inflation, product mix, promotions, commodities, packaging, manufacturing variances, freight, productivity, foreign exchange, and validating both data and accounting classification. Question 7. Kraft Heinz is known for zero-based budgeting. How would you explain its relevance to FP&A? Zero-based budgeting requires spending to be justified from the value and activities needed, rather than automatically rolling forward last year's cost base. In FP&A, I would help identify spending drivers, challenge recurring costs, quantify savings opportunities, and distinguish productive investment from inefficiency. At Kraft Heinz, the discipline can support productivity and reinvestment in brands, innovation, or capabilities. I would also monitor whether savings are real, sustainable, and achieved without undermining service, quality, or long-term growth. Mention rebuilding spending from business needs rather than automatically carrying prior costs, challenging low-value activities, protecting growth investments, tracking savings, and avoiding short-term cuts that damage brands or capabilities. Question 8. Tell me about a time you identified an error in a financial report or forecast. In a prior reporting cycle, I noticed a forecast expense was unusually low compared with the run rate. I traced the issue to a missing accrual for services received but not yet invoiced, confirmed the timing with the business owner, and updated the forecast after consulting accounting. I communicated the impact before submission and added a recurring accrual checklist to the process. The experience reinforced that analytical judgment and disciplined reconciliations are equally important in FP&A. Make sure to use a clear situation action result structure, explain the control or reconciliation performed, quantify the impact where possible, communicate professionally, and describe the preventative improvement. Question 9. How would you forecast the impact of a commodity price increase on Kraft Heinz earnings? I would quantify the affected input volumes, current and expected prices, purchase timing, supplier contracts, and any hedging protection. I would model the gross profit impact by product and period, then layer in inventory timing, potential pricing actions, productivity savings, and demand elasticity. I would create base, upside, and downside scenarios because recovery may not be immediate. The final output would show the earnings exposure, key assumptions, management levers, and residual risk for leadership. Focus on exposure volumes, contracted versus spot purchases, timing, hedging, standard costs, pricing actions, productivity, inventory effects, gross margin, scenario analysis, and communicating assumptions and uncertainty. Question 10. What KPIs would you monitor for a Kraft Heinz brand or category? I would monitor net sales, organic growth, volume, price, mix, gross margin, adjusted operating income, market share, distribution, promotion effectiveness, innovation performance, inventory, and cash conversion. The right emphasis depends on the decision. A brand launch needs distribution and repeat rates, while a cost program needs productivity and margin. I would connect operational KPIs to financial outcomes rather than reviewing them in isolation. That linkage helps explain performance and prevents teams from optimizing one metric at the expense of another. Discuss net sales, volume, price, mix, gross margin, adjusted operating income, market share, distribution, promotional effectiveness, innovation, cash conversion, inventory, and metrics tailored to the business question. Question 11. How would you evaluate whether a marketing or promotional investment was worthwhile? I would compare incremental profit generated with the full investment, including media, trade spending, discounts, and execution costs. First, I would establish a baseline using comparable periods, markets, or control groups, then assess incremental volume, price realization, mix, repeat purchasing, and cannibalization. I would separate shipment timing from true consumption where possible. A promotion can grow revenue yet destroy profit, so I would recommend scaling, redesigning, or stopping it based on returns and longer-term brand effects. Be sure to cover incremental volume and profit, baseline demand, cannibalization, trade spending, customer response, timing, attribution limitations, return on investment, and balancing short-term results with brand health. Question 12. Describe how you would build a scenario analysis for an uncertain business outlook. I would identify the few assumptions with the greatest earnings sensitivity, such as volume, pricing, commodities, foreign exchange, and promotional spending. I would build a base case using the latest operating data, then create realistic upside and downside cases with explicit assumptions. I would quantify sales, profit, cash, and key KPI effects, validate the scenarios with commercial and operations teams, and define trigger points. That lets management prepare actions instead of treating uncertainty as a single unexplained forecast number. In your answer, include a clear base case, upside and downside cases, key drivers, sensitivities, probability or risk assessment, cross-functional input, trigger points, and decision recommendations rather than unsupported numbers. Question 13. How do the income statement, balance sheet, and cash flow statement connect in FP&A? The income statement shows profitability, while the balance sheet captures the resources and obligations that support the business. Net income flows into retained earnings, and changes in receivables, inventory, payables, and other working capital accounts reconcile earnings to operating cash flow. Capital spending increases assets and reduces investing cash, while debt or dividends affect financing cash flow and balances. In FP&A, I would ensure the three-statement forecast is internally consistent because profit growth does not automatically mean stronger cash generation. Focus on earnings flowing into equity, working capital linking profit to operating cash flow, capital spending affecting assets and investing cash flow, financing movements, and balance sheet checks supporting forecast integrity. Question 14. How would you handle a business partner who disagrees with your forecast assumptions? I would first understand the partner's operational knowledge and clarify exactly which assumption differs. Then I would compare the underlying data, such as customer plans, shipment trends, historical accuracy, or supplier information, and distinguish facts from judgment. If uncertainty remains, I would present both scenarios with quantified financial consequences and agree on a monitoring plan. I would document the assumption owner and escalate only when the difference is material. The objective is a reliable forecast, not winning an argument. Mention listening first, clarifying definitions, using evidence, separating facts from judgments, presenting scenarios, documenting ownership, escalating material differences appropriately, and preserving a collaborative relationship. Question 15. Why do you want to join Kraft Heinz and why FP&A? I am attracted to Kraft Heinz because its iconic brands operate at meaningful global scale, where pricing, consumer demand, innovation, and supply chain execution create real analytical complexity. FP&A appeals to me because it combines financial discipline with direct business partnership. I would enjoy turning detailed data into insights that help teams allocate resources, improve margins, and grow brands. I also value the company's productivity and transformation focus, where rigorous analysis can translate into visible operational impact. Be sure to connect interest in iconic brands and consumer products with analytical problem-solving, cross-functional exposure, operational scale, Kraft Heinz transformation priorities, and a specific contribution you can make. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.